There comes a point in every trader's journey when the screen stops feeling like an opportunity and starts feeling like a mirror. Every red candle reflects your doubt. Every loss feels heavier than the last. The silence between trades grows louder, like the market itself is whispering. You've lost it. I've been there. So had Jesse Livermore, a man who made and lost fortunes not once, but 4 times in an age when recovery wasn't guaranteed. He called those stretches dark seasons. They were moments when nothing made sense, when setups that used to print profits suddenly turned against him, and confidence slipped through his fingers like sand. Most traders crumble there. They try to win it back too fast. They widen stops, double sizes, take signals they don't believe in, and soon they're not trading. They're fighting ghosts. But Livermore didn't just survive those streaks. He used them. He studied them. And from them, he built the mental blueprint that would define his entire philosophy of market mastery. He understood that losing streaks don't destroy traders. They reveal them. They show what's real and what's borrowed, whether your discipline is habit or hope, whether your conviction is trained or emotional. That's where his philosophy began, not in profit, but in pain. In those losses, Livermore developed an emotional architecture, rules for when not to trade, principles for protecting mental capital, and the patience to let clarity return naturally. He learned that the worst thing a trader can lose isn't money, it's perspective. In this film, we'll walk through that architecture. I'll take you inside Livermore's mind during his darkest cycles. The mental stages he mapped: denial, frustration, reflection, recalibration, and the techniques he used to transform despair into data, losses into leverage, chaos into control, because losing streaks are not a curse. They're an initiation. They separate the hopeful from the prepared, the impulsive from the professional, and that's where we begin. Not with a chart, not with a setup, but with the silence between losses, the space where Livermore rebuilt himself. Trade by trade, thought by thought. The inner conflict or market paradox. A losing streak splits me in two. One part of me wants to slow everything down, reduce size, and protect the account like a surgeon protecting a heartbeat. The other part wants to speed up, swing bigger, and erase the pain in one perfect trade. Those halves speak with equal conviction, and the paradox is that both make sense in isolation, and both are deadly in excess. Livermore lived inside this paradox. He recognized that the same mind that builds a method will try to abandon it the second it hurts. The market doesn't have to beat me. My reflexes will do it for free. Here's how the inner conflict unfolds. Losses compress my sense of time. Instead of thinking in weeks of context, I think in minutes of relief. I stop asking, is the environment tradable? And start asking, where can I get it back? That question is poisoned from the start. It moves me from reading the tape to needing the tape. The danger isn't the red number. It's the shrinking perspective wrapped around it. Livermore solved this by separating identity from conditions. First he asked, what kind of tape is this? Forgiving, neutral, or ruthless? In a forgiving tape, trend carries small errors. In a ruthless tape, perfection still bleeds. When he labeled the tape as ruthless, he downshifted before his ego could upshift. Size fell, frequency fell, and the bar for proof rose. He didn't moralize a drawdown. He resized to match weather. That's not cowardice, that's calibration. Another layer of the paradox is that pain demands action, while edge often demands inaction. After 3 losers, inaction feels like failure. But Livermore treated restraint as a position. He would go long cash while he rebuilt clarity. To him, doing nothing was not indecision. It was a deliberate allocation of attention. He called it sitting tight when there was nothing to do and doing quickly when the market finally proved it. The transition from stillness to decisiveness was his craft. Then there's the argument inside my head about conviction. Early in a streak, conviction sounds noble. By the middle, it's just stubbornness with better vocabulary. Livermore's antidote was the sequence that never changes. Observe, confirm, commit, sit. In a streak, my mind tries to reverse it. Commit, justify, ignore. The first sequence creates optionality. The second sequence traps me in narrative. When I feel my thinking drift toward narrative, it has to bounce. It's due. I know I'm negotiating with the market instead of listening to it. He also separated information losses from ego losses. An information loss is the small, predefined fee I pay to learn that this setup doesn't work in this tape. An ego loss is the escalating cost of proving I was right. One compounds skill, the other compounds damage. During a streak, my only job is to keep every loss in the first bucket. That means smaller size, fewer decisions, and criteria that cannot be edited after entry. The paradox ends where structure begins. When rules make the decisions, daily max trades, pre-declared proof and disproof, time stops alongside price stops, the room for improvisation shrinks, and with it the room for self-sabotage. This is how Livermore kept his hands gentle and his rules loud when the urge to force was at its peak. When you're down 3 trades, which instinct shouts louder, slow down and resize or press and recover? Tell me below. I'll tailor the next section to the trap you face most. When a losing streak extends beyond logic, it becomes a psychological ecosystem of its own. The market stops being a collection of prices and starts becoming a field of emotional triggers. Every tick is personal, every candle feels like judgment. I remember realizing, as Livermore once did, that losing streaks don't just drain your account, they drain your perception. You begin to see trades not for what they are, but for what you need them to fix. The core problem is that loss changes the brain's chemistry. The fear of pain overrides the logic of process. You move from strategy-based behavior to survival-based behavior, and that transition is invisible while it's happening. One day you're following your setup perfectly. The next, you're just clicking to feel something. The trader's trap isn't the loss itself. It's the belief that one trade can erase emotional discomfort. Livermore described this as the revenge reflex. After a string of failures, even the most disciplined mind searches for a redemption trade. The irony is that the urge for redemption blinds the senses that once created precision. What was once calculated becomes compulsive. You start seeing signals that aren't there, patterns that don't exist, confirmation in noise. The brain manufactures hope faster than the market manufactures opportunity. The second part of the trap is the illusion of rhythm. After a few losses, the mind tries to time its comeback. It waits for luck to align with emotion. But Livermore realized that markets don't owe rhythm to anyone. The same setup that failed yesterday can fail again today because the tape doesn't reset for your feelings. Believing otherwise turns analysis into self-deception. Then comes the most dangerous form of fear, the subtle kind. Not the panic of loss, but the whisper that says, "Don't miss the next one." That fear disguises itself as urgency. It convinces you that waiting means weakness, that patience means paralysis. Livermore battled this constantly. He once wrote that the desire to trade all the time is the greatest enemy of a successful operator. It's not the bad trades that destroy a trader, it's the need to constantly prove you're still capable. At this point, logic and emotion switch places. Logic starts making excuses and emotion starts doing the thinking. You convince yourself you're following your rules, but really, you're rebuilding them around your fear. Livermore identified this moment as the point where most traders implode, not from ignorance, but from ego fatigue. The rules are known. They're just temporarily inconvenient. He treated this stage as a signal, not a sin. When he felt himself needing the market, he stepped away. No dramatic gesture, no speech, just absence. That absence was discipline in disguise. He understood that trying to fix emotional damage with market activity is like trying to cure thirst with salt water. A losing streak isn't just a test of capital, it's a test of self-awareness. It asks one question. Can you let pain exist without assigning it meaning? Livermore learned that lesson through experience, and it became the foundation for what came next, his method of transforming emotional chaos into data clarity. Jesse Livermore saw losing streaks not as failures, but as diagnostic tools. To him, a drawdown was a mirror the market held up to show where discipline had cracked. He believed that the market was never wrong, only his interpretation of it could be. When he lost, he didn't curse the market's cruelty. He studied his own impatience, his timing, his overconfidence. Losing streaks became his form of tuition, and each one taught him what profits never could: emotional neutrality. Livermore wrote that every trader must teach his brain to trade as mechanically as the tape prints. What he meant was that the emotional reaction to a losing streak had to be stripped of ego. The goal wasn't to win the next trade. It was to restore the ability to see clearly. In his view, clarity was the most valuable capital a trader could hold. Without it, every decision was corrupted by invisible bias. He never viewed the market as something to conquer. Instead, he treated it as a living organism, one that reflected collective human psychology. When he lost repeatedly, he assumed that either the market's rhythm had shifted or he had stopped hearing it. In both cases, the solution was the same: stop trading and listen. That pause wasn't weakness. It was recalibration. He would reduce his positions to zero, go to his office, and spend days studying the tape until his sense of rhythm returned. Livermore also believed that every streak carried a message. Sometimes the message was technical. His setup was no longer aligned with the broader cycle. Other times it was emotional. He was too confident, too active, too sure of himself. Either way, his response was the same. Humility first, participation later. That humility wasn't passive. It was practical. It allowed him to reset without resentment, to approach the market again without emotional residue. He often said, "After a man makes money in the market, he must learn to sit tight. But after he loses, he must learn to sit still." It's the second part that defines professionals. Anyone can hold a winner. Few can hold themselves through a storm. Livermore's brilliance was that he built systems not only to make money, but to survive the psychological drawdown that comes when the system fails temporarily. He viewed losing streaks as part of the natural rhythm of trading, an inevitable ebb between phases of clarity and confusion. Instead of resisting that rhythm, he aligned with it. He didn't chase recovery. He waited for conditions to invite him back. This mindset kept him from compounding losses with emotion. It allowed him to re-enter only when logic had reclaimed the steering wheel from pride. What Livermore understood, perhaps better than anyone of his time, was that recovery doesn't begin with action, it begins with alignment. When the internal tempo matches the external rhythm of the market, execution becomes effortless again. Until then, every trade is just noise pretending to be a comeback. That perspective reshaped how he saw both profit and loss. A winning streak didn't make him a genius, and a losing streak didn't make him a fool. Both were conditions to be managed, not identities to be lived. From that foundation came one of Livermore's most powerful case studies, a real-world moment when he faced complete ruin, yet turned that collapse into the very formula that rebuilt his fortune. Real-world example or story moment. In 1907, Jesse Livermore faced a storm that would test every part of his mental blueprint. The panic of 1907 wasn't just a market crash. It was a psychological collapse across the financial world. Banks failed overnight, credit froze, and even seasoned operators lost their sense of direction. Livermore, who had already tasted both fortune and ruin, entered that period not as a gambler, but as a student of human behavior. He began by watching, not trading. He spent days in silence, reading the tape at the New York brokerage offices. The crowd was panicking, everyone dumping positions, desperate to escape the fall. Livermore didn't join them. He wasn't calm because he was fearless. He was calm because he had seen fear before. He recognized its rhythm, the sharp selling, the fake rallies, the exhaustion that always follows hysteria. He waited for the point when panic would reach saturation, when sellers would become too tired to sell anymore. That, he believed, was the only true bottom. As the market spiraled downward, he slowly began to short. Not aggressively, not impulsively, but in stages. Each short position was small, and he added only when the tape confirmed further weakness. When others screamed that it couldn't go lower, Livermore let the market prove them wrong. He didn't predict. He responded, what happened next would define his career. As the panic deepened, Livermore's methodical shorting turned into one of the greatest trading triumphs in history. He reportedly made over $3 million, a staggering fortune at the time. But what mattered most wasn't the profit, it was how he handled the recovery after success. When the market finally stabilized and J.P. Morgan himself stepped in to halt the panic, Livermore reversed his positions. He began buying, not because the crowd told him to, but because the tape did. That same clarity, however, didn't last forever. In later years, Livermore would lose much of his fortune again, not because his method failed, but because he broke his own discipline. Fame, overconfidence, and emotional exhaustion made him abandon the very stillness that had made him great. Each downfall traced back to the same origin, impatience disguised as conviction. The 1907 panic became both his greatest victory and his greatest warning. It taught him that control wasn't about prediction or intellect. It was about emotional endurance. The man who could stay silent in chaos, wait through boredom, and act only when proof arrived, that was the man who survived. For modern traders, this moment captures everything Livermore stood for. His profits came not from superior information, but from superior composure. His losses came not from ignorance, but from forgetting that composure. Every losing streak, every emotional collapse was a smaller version of that 1907 panic, a battle between reaction and restraint. Livermore didn't fight the market. He learned when to let it fight itself. That lesson became his compass through every future drawdown. In the next part, we'll explore how that same composure was tested again, when even Livermore, the master of discipline, fell into the emotional abyss he once conquered. What happens when the teacher fails his own lesson? That's where the deepest insight lives. There came a time when even Jesse Livermore, the man who had faced down panics and conquered fear, fell into his own spiral. It was the late 1920s, after years of triumph, prestige, and wealth that few men could comprehend. The market had become his playground, and his confidence, though well-earned, began to shift into something far more dangerous: entitlement. The same instincts that once protected him from the crowd now whispered that he was above it. When the market began to change its character, Livermore was slow to adjust. The tape that once spoke so clearly became confusing, erratic, almost deceptive. His signals contradicted one another, and for the first time in years he ignored his own principle: wait for confirmation. Instead, he acted on the memory of being right. Each loss fueled a desperate need to recover, and each recovery attempt came from a place of emotion, not precision. His trading desk became a quiet battlefield. Reports from those who knew him describe him sitting still for hours, staring at the ticker, unable to pull the trigger, but equally unable to walk away. It wasn't the money that broke him, it was the loss of rhythm, the disconnection between his instinct and the market's behavior. For a man who once made millions by sensing mass emotion, losing that sense was like going blind. The spiral deepened. Each mistake led to self-recrimination, and each self-criticism led to hesitation. The trader who once flowed with the tape now second-guessed every flicker of movement. The silence that once centered him now mocked him. He called it mental paralysis, the phase where knowledge and action part ways. You know what to do, but you can't do it. Livermore's journals from that period reveal not despair but analysis. He began dissecting the structure of his downfall the same way he had once studied market behavior. He wrote that the hardest loss to overcome is the loss of confidence. Confidence, he realized, wasn't built on winning. It was built on trust in your own rules. The moment you abandon them, even once, the foundation cracks. This was his lowest point, yet it was also the beginning of renewal. Because even in defeat, Livermore didn't lose curiosity. He began to notice how his mind behaved in pain, how impatience disguised itself as intuition, how fear of missing out dressed as discipline. Those observations became the seeds of his mental blueprint, the emotional operating system that would define the final stage of his trading evolution. He came to understand that the real battle wasn't between trader and market, but between trader and self. The charts, the numbers, the strategies, those were just mirrors reflecting internal states. Once that truth became clear, the path forward revealed itself, not through new setups or systems, but through restoration of inner stillness. That realization marked the turning point. Livermore had lost fortunes before, but this was different. This was about regaining himself. And from that moment of stillness, he began constructing the framework that modern traders still follow today, the blueprint for rebuilding from the bottom without emotional reside. Livermore's breakthrough rule, or lesson from. The ashes of his collapse came Livermore's greatest insight. A rule so simple that it bordered on philosophy. Wait for the market to confirm your opinion before you act on it. This wasn't just a trading strategy. It was emotional architecture. Confirmation was proof. It was the dividing line between belief and evidence, between impulse and intelligence. Livermore realized that during his worst periods, he wasn't losing to the market. He was losing to his own need to be right. He acted on forecasts, on expectations, on the illusion that he could see the future. But the future was never the problem. His timing was. The market rewards only one thing: alignment with its current truth. And that truth only appears through confirmation. He began applying this principle not just to price action, but to his emotional state. Before he placed any trade, he would check himself. Was this setup confirmed by the tape, or by my ego? If he felt tension, urgency, or the need to make it back, he recognized those signals as warnings. Emotion was a market indicator too, one that predicted his next mistake. Livermore's rule evolved into 3 layers. The first was market confirmation: never enter until price and volume both agree. The second was emotional confirmation. Never act while in reaction mode. The third was situational confirmation. Never trade outside your structure, no matter how tempting the setup looks. This layered discipline turned trading from reaction to rhythm. He didn't try to anticipate the market anymore. He waited for it to declare direction. His timing sharpened, not because he learned new patterns, but because he learned how to stop forcing old ones. He replaced his need for control with the skill of observation. He described it as letting the market speak first. It sounds passive, but it's the purest form of professionalism. By the time the crowd sees a move, the disciplined trader has already confirmed it quietly. By the time greed takes over the masses, Livermore was already in, or already out. This rule became his stabilizer. It kept him from chasing the first uptick of recovery after a losing streak. It allowed him to re-enter calmly, with logic restored and emotion neutralized. His comeback trades were smaller, slower, and more precise. They were never acts of revenge. They were simply the continuation of a system that had paused for recalibration. Livermore's confirmation rule wasn't about perfection. It was about probability weighted by patience. He accepted that not every move needed to be caught, not every signal needed to be traded. Missing an opportunity was cheaper than forcing one. And over time, that single idea turned his drawdowns into the foundation of his resilience. He understood that market mastery didn't mean predicting movement. It meant moving only when movement was verified. That one shift, from anticipation to confirmation, separated him from nearly every trader who ever followed. In the next part, we'll look at how this timeless rule applies to today's markets, where speed and distraction test discipline more than ever, and where Livermore's mindset might be the only anchor left for traders trying to stay sane in chaos. The modern trading environment is faster, louder, and far more demanding than anything Jesse Livermore ever faced. Yet the psychology behind it has barely changed. The screens may have multiplied, algorithms may execute in milliseconds, and data may flood every device, but the human behind the keyboard remains ruled by the same two emotions, fear and greed. Livermore's principles survive precisely because they were designed for the mind, not the market structure. Today's trader has access to every possible metric: volatility indexes, heat maps, volume profiles, sentiment scores, but still struggles with the same problem Livermore confronted a century ago: acting too soon. The fear of missing out has evolved into an algorithmic addiction. It's not just emotional anymore. It's neurological. Notifications, price alerts, and flashing dashboards stimulate dopamine, tricking the brain into equating activity with progress. Livermore would have called it noise disguised as opportunity. His concept of confirmation is the antidote. In modern markets, confirmation means clarity through structure, waiting for alignment between multiple independent signals before acting. For example, a trader might see a breakout forming. Instead of rushing in, they wait for volume to expand, a retest to hold, and market sentiment to stabilize. Only when all those conditions align does confirmation exist. Livermore's wisdom teaches that this patience doesn't delay profits, it protects them. He also understood something that today's traders often overlook. Confirmation is not about prediction, it's about permission. It gives you permission to act without hesitation because the market has validated your thesis. When you wait for confirmation, you trade from evidence, not emotion. That's how Livermore stayed calm while the crowd lost its head. For the modern investor, this philosophy translates into more than just chart work. It extends to managing capital, managing time, and managing self. If your system hasn't shown consistency over 100 trades, it hasn't earned confirmation. If your mental state is scattered, distracted, or fatigued, your emotions haven't confirmed readiness. Livermore's brilliance was seeing that confirmation applied equally to psychology and price action. Both needed alignment. He would likely warn that today's biggest danger isn't volatility, but overstimulation. Modern traders don't lose because they lack information. They lose because they can't filter it. The constant stream of opinions, predictions, and headlines erodes patience. Livermore's method acts as a firewall. It restores stillness, reminding you that not trading is a strategy, not a failure. What makes his approach so powerful in the digital era is that it brings the trader's focus back to the essentials: observation, timing, and self-awareness. Those who adopt this mindset transform the market from a storm into a mirror. Instead of reacting to every headline, they learn to wait for the pulse, the alignment of price, volume, and emotional equilibrium, before moving. Livermore's principles have outlived every technological revolution in finance because they don't depend on technology at all. They depend on character. In a world obsessed with speed, his legacy reminds us that endurance is the real edge. And confirmation, that patient validation of truth, remains the bridge between chaos and control. In the next section, we'll break down how to take Livermore's philosophy and turn it into a practical daily process, a modern trading framework that transforms his century-old wisdom into a system any disciplined trader can live by step-by-step practical implementation to turn Livermore's philosophy into a usable structure. The first step is simplification. He believed that clarity begins when clutter ends. Start by defining what a valid trade looks like, not vaguely but precisely. Write it down: the setup, the signal, the volume behavior, the confirmation criteria, and the invalidation point. This transforms your emotional impulses into mechanical conditions. When you feel the urge to trade outside those boundaries, you're not making a decision. You're breaking structure. The next step is preparation. Livermore started his day studying the tape before making a single commitment. In modern terms, that means analyzing the market environment. Is volatility expanding or contracting? Are correlations strengthening or breaking down? Identify which conditions favor your system and which conditions demand caution. Preparation creates awareness. Awareness prevents reaction. Step 3 is confirmation. Once your setup appears, wait for the market to verify it. For example, if your plan involves buying breakouts, don't buy the first surge. Wait for volume expansion or a retest that holds support. Livermore's idea was that the market should show its hand before you show your capital. If confirmation never comes, neither should your trade. Step 4 is execution through scaling. Livermore rarely went all in. He entered in fractions, testing each position with the market's feedback. Modern traders can mirror this by starting small, risking perhaps 1/3 of the planned position size, and only adding when the trade continues to prove itself. This keeps emotion small while confidence builds naturally. Step 5 is observation after entry. Once in, your job shifts from prediction to verification. Watch how the market reacts. Is it behaving according to your plan or showing signs of fatigue? Livermore said that losing trades announce themselves early, not in price but in behavior. Weak reactions, slow follow-through, or inconsistent volume are early warnings. Don't rationalize them. Adjust or exit mechanically. Step 6 is journaling and review. After each session, Livermore would analyze his trades and his mood. He treated both as data. Modern traders can use journals to record the reasons behind each decision, the emotions present, and the results. Over time, this log becomes a mirror, showing patterns in your behavior that no chart can reveal. Step 7 is resetting the emotional baseline. Livermore knew that every win or loss leaves residue. Wins breed euphoria, losses breed hesitation, both distort judgment. His solution was to detach from the market after heavy emotion. Take breaks, exercise, walk, or simply step away from screens. The next session should begin with a mind unburdened by yesterday's outcome. Finally, step 8 is reflection and recalibration. Review your process weekly. Are you trading within your system or chasing setups outside it? Are your confirmations consistent, or are you redefining them mid-trade? Livermore's goal was not perfection, but progress through precision. This structure creates what Livermore called emotional rhythm. Each stage, preparation, confirmation, execution, observation, reflection, flows into the next like beats in a controlled tempo. When followed, it neutralizes impulsiveness and restores clarity. It transforms trading from reaction into ritual, from chaos into choreography. This was Livermore's real genius, not just finding patterns in the market, but finding structure in himself. When the screens finally go dark and the market's noise fades into silence, what remains isn't profit or loss, it's process. Every trader, whether in Livermore's time or today's algorithmic age, eventually learns that the market isn't a battle of intellect. It's a mirror reflecting emotional truth. The numbers change, but the psychology remains constant. Fear, greed, hope, and doubt, they're the same four currents that have pulled every trader since the first exchange opened its doors. Livermore's story is both warning and wisdom. He mastered the rhythm of speculation, turned patience into a weapon, and confirmation into armor. Yet he also showed that no mastery is permanent. Discipline fades when ego replaces observation, and clarity erodes the moment emotion takes the lead. His legacy isn't in the millions he made or lost, but in the mindset he left behind: control the self, and the market will follow. The trader's path is not linear. There will be seasons of confidence and stretches of confusion, moments of triumph followed by stretches of quiet recalibration. Livermore understood that the measure of professionalism isn't found in how one performs during rallies, but how one behaves during drawdowns. True strength lies not in aggression, but in endurance. Not in endless action, but in the ability to wait without anxiety. In the end, Livermore's mental blueprint isn't just about trading, it's about identity. Each decision reveals what you value: impulse or structure, pride or patience, reaction or response. Every losing streak, every missed setup, every moment of silence between trades is part of the same test. The market doesn't punish emotion, it exposes it. The trader who learns to observe his own emotions with the same precision he observes the tape will never truly be out of rhythm. Livermore's ghost still lingers wherever traders gather, in the quiet between price ticks, in the hesitation before pressing buy or sell, in that inner voice that asks, is this trade confirmed? Or is it just my need to be right? The answer to that question separates the professional from the participant. A century later, his lessons still breathe. Wait for proof, trade without urgency, and protect your clarity as fiercely as your capital. The charts will evolve, the platforms will change, but the inner market, the one within your mind, will always be the same. If there's one truth that defines Livermore's philosophy, it's this: the market rewards patience, but it saves its greatest rewards for those who master themselves first.